Yo, guys, welcome to Elite Acquisitions and Investment Banking. This is Friday night reboot number 2. Today's topic is going to be business negotiations. So I'm going to give it a minute so a couple people hop in. And we're going to talk about, first of all, building rapport with the business owner. I'd also like to touch on decision making. That is key. Are you negotiating with the decision maker, or are there other parties involved? Let's give it a minute. All right, guys, I'll get started, and as people hop in, you can watch the replay. So that's not an issue. We got 2 members already. Whoever's watching, invite others to spread the word. Just bring the insights. So one thing I usually see when negotiating is that a lot of people think rapport is just one side of the negotiations or one part of the negotiations. Rapport involves the whole transaction, the whole negotiation process. What I mean by that is, if you build rapport in the beginning and you don't continuously keep building it throughout the transaction, uh, you're giving them a lack of trust. You always want to maintain a level of trust with the business owner, that they know you're a person of honor and integrity and you're doing things to the best of your ability. That's where bringing in a board member comes into play, because you're bringing in an expert who's been there and done that. You don't want to seem like you don't know what you're doing, because that is definitely going to kill the trust. On another note, coming down to negotiating, you want to make sure the person you're negotiating with is either a decision maker, a key decision maker, or the decision maker. And what I mean by that is, a lot of times, just because the person or the business owner, and this is usually seen in lower middle market businesses, uh, if they own 100% of the equity and it's a family based business, there could be other people involved in the opinions of the negotiation. What I mean by that is, there was this one negotiation I had. It was a doctor, and I asked the doctor, I see you own 100% of the business. Are you the sole decision maker? He told me no. He told me his wife was a major decision maker, an influencer within the company. So I'm like, hey, let's bring her on. What I mean by that is, you don't want to pitch the guy who can't take the decision, who can't give you the yes or no. So if there's other people involved, bring them on board, pitch it to them, and then come up with a decision in a timely fashion. You can comment any questions you have, and I can respond to you as we go. Just getting started here. Today I was reading this book. I just picked it up. It's called 21 Secrets of $1 Million Earners. $1 Million Sellers. And there's one point I like to touch on that really speaks. And it's called simple, you know. So let me give you an example here. It says, for Sony, a luxury automotive salesman, simple means understandable. As he explained to me, when you help a client truly understand your product or service and what makes it different, special, and better, the client starts to trust you. The client engages, the client sees the benefits. Most important, the client buys. If you cannot explain what you're doing in a simple and concise manner, you don't understand it. And a lot of these guys, they're not corporate. For the most part, they're involved in the business instead of on the business. So they're looking at things in a micro perspective. So you got to really break it down to them to where you're showing them the bigger picture. This is why. I understand what you're doing, I understand your involvement, but I like you to see a little more. I like you to see a little more further ahead. Let me paint a picture for you. So you want to be able to show them why you're the best option for him in the marketplace. And a lot of people think it's just the price. The better offer wins. Yes and no. But I saw a case where there was this guy and he was interested in buying this company. He was interested in buying his boss company, the one he works in. And he got an offer from a private equity firm, and they were offering him, I think it was 6 times earnings or EBITDA. And the thing was, the condition with the private equity offer was that he won't be able to stay on board, meaning he has to go. He just cashes out, walks away. He wasn't looking for that. He was looking to stay on and grow. So I told him, I'm like, hey, you could approach it this way. Approach the guy and, pitch him, hey, I've been involved with your business. I understand it. Myself, I'm looking to grow and do bigger things. Instead of starting something from scratch, why not let's partner up and take this to the next level? And I'd like you to stay on it as you're the owner. Was the owner, but you're the person who has the vision and grew it to where it is today. And together, let's take it to the next level. And that really opened up the conversation for him, because the other person saw it was not just about, cashing him out and kicking him out, but essentially building something greater. And that's where we break to where there's 3 reasons why somebody would sell: time, money, or expansion. Let's start with money. For the most part, these are the businesses or the business owners that are desperate, right? These are the type of businesses you'll pick up if your pitch is only, are you interested in selling? Let me buy it. Because what happens is these guys are cash strapped. The business needs working capital, an inflow of working capital to be able to continue operations, or the person, has an emergency and he needs to cash out, or he needs money, and he cannot or does not want to take on huge amount of debts personally. It's a 50-50 chance depending on how the business is and how open the owner is to negotiate. But those are the type of businesses I'm not interested. I'm interested in business owners who are looking to retire or are looking to expand, and I'll tell you why. If a business owner is looking to retire, that means he's built something to where he sees fit, it could run itself. And that's what I'm interested in. Meaning, and this is one of my questions, John, have you thought about selling or retiring anytime soon? And it touches both points. They're either looking to sell or they're either looking to retire. And if they say, well, I'm looking to retire, and you say, great. Well, let me ask you this. Does your business currently have the systems in place to allow for that retirement? And then he's going to think. He could be like, yeah, it does. And you could ask, what type of systems? Well, management. Management can run the company. Right. Do you personally have a succession plan in place? Meaning, and it's natural and it happens to us all, but when your day comes, who's going to take, the lead in this company? Oh, well, my son. They really don't have options. So you just want to lay it all out and exhaust all their possibilities. And then make them realize, well, they're just basing themselves off management. And that's where we would come in. And I'd come in and I'd pitch, and well, we want to ensure this company grows and expands for decades to come. We want your legacy to live on. You've created something that's benefited the people and it's benefited the community and has helped many others. Let me help you now. And yes, there's emotions when speaking with these business owners. The business is their baby, and this is where I see a lot of people cannot see themselves taking a more compassionate approach with the business owner. Give me a second, guys. We're back. So we got retirement. Now, when it comes down to an offer, usually I want them to hold on to some equity. Reason is, and I asked them, John, do you really need the money or do you have some time to leverage? And they might be like, what do you mean? Well, I want you to understand when somebody sells a large asset, business, property, so on, there's capital gains. And capital gain taxes go for about 40%, give or take. It could be a little more with Biden. But that's 40% that's just getting taken away. And I don't want you to outlive your money. So I want to build you a retirement plan. And what I mean by that is you could take a portion of the payment over a series of years. Think of it as a safety net. And the way I explain seller finance that makes it extremely simple is, do you know how banks make money? And they might know, yeah, they make money by lending money, right? Yeah, they make money on the interest. So there's two ways. You could explain this way, you could explain the real estate way. And I'm like, they make money on the interest. So when you hold the note, you're essentially becoming the bank for us. So not only are you capitalizing on the principal, but you're also taking in interest, which leads to a greater amount. Simple way to explain it. If they're giving you a hard time, or you can also say, it's just the same thing with a piece of property. You got a piece of property, I'm looking to buy it. Instead of involving the bank, I will take a note from you, the equivalent of a mortgage, and I'd pay you directly. Very simple. So you explain that and you let them know, because they're taking it over a series of years, they ease on taxes and they're able to make more over time. The incentive of seller finance is for them to make more over time, which will compensate for the loss in taxes. If not, they just take it all front. That's where interest comes. And we go for about a 4% interest rate. Moving on to expansion, which is the best in my opinion. And I look for businesses. I look for business owners who don't want to sell. Why? Well, because they got something, and they got something that's going really great. Why would you want to sell? It's just getting started. You see it in your mind. There's a lot of room for growth and expansion. That's how I get these guys. I pitch them growth. I pitch them expansion. I pitch them why should they be a part of my network of businesses. I pitch them what I'm looking to do and where they can fit in and benefit. Essentially, what can you offer them that they cannot offer themselves? And I'll give you a simple example. I'm looking at physician offices and doctor offices. I know, and you got to do your research, but I know these are usually community doctors, community offices. They service the people around them. And usually the doctor or the physician is the business, basically the owner's the business. So they don't really have the systems in place to allow for retirement. And they're so involved in the business that they're not focused on the business. What I mean by that is most of the times they don't run marketing. So they might have problems when it comes down to patient flow. Also, a lot of these small businesses, they're not up to standard with other larger firms, and thus their reviews would be lower. Remember, when somebody new comes into an area, what do they look for? They look for the reviews, Google reviews. So when you come in and buy these businesses, you're giving them another chance to clean their image. So what am I offering them? I'm offering them the chance to expand, where we could turn their single physician office into a multi-physician model, and they could capitalize on the growth. And I'm offering them the option of retire, where we would bring a doctor to replace him, and his business doesn't have to go out. His legacy will live on. So what can you offer them that they cannot offer themselves? And that's your value proposition. and you really want to make them think and understand of their situation, because a lot of people are just too involved with the day to day. They forget about the day of tomorrow. So those are a lot of points to take into consideration when it comes down to negotiations. Who's your client, and what are they looking for? Let me see where else. Okay. Now, the more I can simplify the language and make it more concrete to them and their personal commitment, the more likely they are to trust my descriptions. So I speak to them in a language they can't understand. I stop saying acquisitions. Instead of saying we're looking to acquire other business, I'm just saying we're looking to buy other practices. Make it simple. Don't confuse them. Once you confuse them, you lose them. Now, I want to talk about cutting the deck. And I got a seller's brochure, which I'm actually going to simplify, because I realize there's a lot of things that are not important to him, but more would be more important to the bank or an investor. Now, here's something I read from the book, and it said at Creative Ventures, every stage presentation we put on begins with what we call a master deck. We capture every idea we have for the program in a slide with images to illustrate each idea. By the time we're done, we have a huge everything but the kitchen sink PowerPoint presentation that would probably take all day to deliver. But since we usually only have about 90 minutes, we use thoughtful reduction to edit down the deck, reducing the master deck to only the slides we think are most important. Is a huge challenge. Once we've done that, we reorient and view the presentation from the audience perspective. Basically, is the information you're presenting him, is that something he has to worry about? Is that something that, he really needs to take into consideration? Does it really affect them in any way? Focus on what they care about, essentially. Very simply put, focus on what they care about. Him as a doctor, what does he care about? Well, he has a practice. There's competition. He usually, basically, let's say the doctor and a tech or an assistant, for the most part, he has the business, doesn't have marketing in place, so patient flow comes and goes here and there. COVID could have affected him, and I always ask, we understand businesses have been affected by COVID, either directly or indirectly. How did it affect yours? And let them speak to you. Figure out all the problems they have and find a solution to them. Or that's a way you can present yourself, right? You speak with a business owner, let's say in construction, and he's looking to expand. Hey, John, I see you're an HVAC company in Los Angeles. Have you thought about setting up shop in San Diego? Expanding nationwide, maybe statewide even to begin, citywide, a couple more shops. Have you thought about getting into roofing, plumbing if you're already servicing these clients? Have you thought about offering them more services? And they'll be like, well, yeah, I have, but I don't have the contractors. I don't have the time. I don't have the resources. I don't have the capital. So figure out every problem they have or everything they're lacking, and that's where you position yourself. That's where you come in to assist them. That's your value you're bringing to them. So analyze your prospect, your customer, figure out what they're looking for, and position yourself. And this is what I learned. Even though it is a numbers game, yes, you don't want to waste the lead. A lot of people just call to call. I call to have a conversation. I call to figure out something, and I call to offer something to this person. Remember, every call has to have an end goal in mind. On the first call, I'm not looking to sell them. I'm not. I'm looking to book a discovery call. On the discovery call, I'm not looking to sell them. I'm looking to build trust and receive their financials. Once I have financials, then we could talk about structure, so on and so forth. Double check any red flags we see, so on and so forth, and then eventually come to an offer. But it's a stage by stage basis. You're not going to close them on a call. You got to understand you're a random person who's giving them a call and they don't understand, or they don't even know who you are, and you're requesting all this information. Sketchy. Build a rapport, build a trust, uh, present yourself in a way where they seem you're an asset and not a liability to them. And remember, a lot of times the business owner just wants to know you're both on the same page. Sometimes it's not just about the money, it's can they work with you? Because if they cannot work with you, it's not going to be a partnership that will last. So those are all points to take into consideration. I'll leave that at this. Any comments you could leave below. Ansie's going to come on the next episode and analyze this and break it down. A lot of points made here. Just analyze who's my customer, who's my audience, how do I figure it out? Speak with them, call them. Hey, John, let me ask you. I see COVID has affected a lot of businesses, either directly or indirectly. How did it affect yours? What problems do you see in your industry? What type of problems you face? Speak to various of them and find a
Hey, can
pattern.
you hear me?
Yeah, I got you.
Yeah, one thing I wanted to touch on tonight. Let's talk about when when you have a mainly, but I see that's why I was not able to chime in. Let me know if I think we're get cut off or anything like that. But I wanted to, bump the price up. So that's something that a lot of people don't come across a lot, but it is something that happened. And what do you do when that happens? For example, if you're looking at a $4 million deal and the seller turns around and say, hey, you know, based on the Q1 performance of 2021, we did some projections and we want 12 million, right? And that's a significant jump. What do? Do you just leave the deal? Do you walk away? Is the seller being unreasonable? Right. So that's what I wanted to touch on. And there's a couple ways to go about doing that. And it's all going to actually, what's going to make or break the deal is the amount that the seller agrees for to take in cash. So basically, the cash consideration at closing. What is that going to be? So just for the sake of argument, the example I gave, just a minute ago, sellers asking for $1 million, and they turn around and say, well, based off the performance of the first quarter of this year, there's some projections. We now want 12 million. Now, is that price justified? Absolutely not. Are sellers able to do that? Yes. um, is it ethical? By far. Uh, is that something that happens? Like I said, quite often. Don't argue with the seller because chances are you're not going to be able to get the seller to come down on the price. So what you want to do is you want to see how is it going to make sense for you as a buyer, to actually make this acquisition. And if the business is worth it and is going to be performing like the projections, say, then the seller wouldn't have any reason of having any kind of milestones or earnouts. So this is a particular deal that I would do an earnout. If not an earnout, a clawback, right? Because a clawback, you could always adjust the price. So what you want to do is, you want to make sure that you give the seller a cash consideration at closing that they're okay with. Because the banks and the investors, they would come in on a deal like this, except, for what the seller is accepting at closing. So if you're saying, hey, seller, we're going to give you 4 million, 5 million at closing, and with that being said, you're looking at a 2.75 or 3.5 DSCR, then, the bank would go for that all day. But what you have to do is you have to structure the deal to where it makes sense. What do I mean by that? So, same example, $4 million deal, seller's asking for now 12 million, just to make them feel comfortable. The earnout situation would work great with this because it's going to be based on performance. And if the company doesn't perform like the seller said, it will, we simply have a EBITDA adjustment. So that way you can give the seller 4 million at closing, right? And the seller's going to hold on to some portion of seller financing to the deal, 10, 20%. Now all you have to worry about is, the remainder, which is going to be a less amount than previously thought. But what you can do is have those milestones and have earnouts, or clawback, because you want to make sure that you're going to be paying the seller based on the performance of the business. Fine, you want to have projections, we can do that too. right? We can reverse engineer whatever valuation you came up with, especially if it's at the top of your head. We can do that easy. Yeah, you want 12 million, fine. Let's arrange that. That's not a problem. But what we're not going to do is give you anything close to 12 million at closing. We're going to give you a 1/3 of that, and based on the performance of the company, it has to hit certain milestones, and maybe based on defined EBITDA targets, then we will pay you accordingly. But other than that, I mean, if the seller doesn't want to accept that, there's no other way to go around that or to get around it. But I had a discussion with my attorney about something similar to this earlier, and this is why I wanted to talk about this. And these are just some of the things that doesn't happen a lot, but you will see them. And like I said, how do you deal with these things? Do you just walk away and tell the seller, hey, you're being unreasonable, there's no way we're going to do that, right? Or do you find a way to structure the deal to where it's going to make sense for you and the seller, banks, investors, or whoever's involved? So yeah, that's the one point I really wanted to touch on. I'll actually drop a video about this topic in more depth after I speak with my my entire board. But yeah, don't be quick to walk away from a deal when if the seller seems like they're being unreasonable, because if you don't close that deal, there's somebody who's going to come behind you and close it, and you're going to wonder how did they close it, right? And you don't want to fall into the trap of being a non-performer. Your name will get ruined in this M&A industry real quickly. So that's the only thing I wanted to really touch on for tonight.
Great. And just to clarify, the down amount would be based on the requirements for the bank or investor.
Historicals.
Yes, as long as it
Wait, wait,
meets,
wait.
it's based on the historicals, but as long as it meets the bank's requirements to fund. Meaning, if you
Yes,
can only
yes,
fund 4 million and they're looking for 12, you only fund four, and the other stuff is
yes,
clawbacks, earnouts,
yes,
so on, based on future
yes.
performance. Correct?
Yeah, because what the seller is saying is they're gonna be coming from a almost $2 million net, right, to I believe around 3.45, almost 4 million, right? So yes, that would justify a $12 million price asking, because if we're at 4 million, if you're netting 3.4, 4 million, of course 12 million, that's only a 3 times multiple. That's a very good multiple, right? Banks like that all day. So we could do that. But if you're telling me that you're going to just go off the 1.8 million and you want 12, I mean, that's not happening. There's no way that's going to work. But so what we did was, previously we know that for a fact, without a doubt, we can pay cash for the deal at 4 million. We can pay that. So because we know that based off the historicals, this is not based off some projections, anything like that, annualized. This is based off true and accurate numbers. We'll say, hey, we'll give you that at closing. We know that we're covered. But what we're not going to do is give you anything past that, you know. But if the company does perform like you say it will, right, like the projections show it will, then by all means, we have no problem paying you that, you know. And the seller shouldn't have a problem with that either, because if they're that confident in themselves, in the performance of the business, they should have no problem with that. Say, hey, guy, here's 4 million. We're gonna hold on to 8, you know, and then if the company perform, December 31st, 2021, when we see that it's over and the company perform like you said it will, we have no problem paying you that out, dude. Especially for the third, second, third, fourth, fifth year. Of course, we have no problem doing that at all, you know. But you have to be very, very. What I'm discussing right now is not a simple strategy, right? Because not a lot of people, like I said, come across it. So it's not going to be something that's simple. It's a lot of moving parts to it, and you definitely want to have your accountant. This is not a job for your M&A attorney. This is something for your accountant to deal with, you know. So have your accountant make sure that you guys are able to, it'll make sense to meet those milestones to pay that out. And of course, the DSCR has to be where it makes sense for the bank to lend on. And even after everything is said and done, what's the free cash flow that's left over? So with taking all those into consideration, there shouldn't be any reason why you couldn't pull a deal like that off, anyone, right? Like I said, but for the average guy, they would hear that. They would be like, well, seller's being unreasonable. You know what I mean? What's happening? How can you make that drastic of a jump from 4 to 12? and they would just walk away. But this is why I say, consult your board, because your attorneys and your accountants, they will know how to get around that. So yes, to answer your question, we know that we're able to pay, a certain amount for sure. So that's the amount we want to stick with as far as the cash consideration at closing. And once you do
Boom.
that,
There
any
you go.
investor, no investor will have an issue with it, because, like I said, you're not actually paying anything above the cash consideration. You know, so yeah, don't easily throw your leads away for your deals that you think the seller is being unreasonable. I don't know how many times I'm gonna say that, but there's always a way around things.
Yeah, and like Ansi said, consult with your board. Consult with your board,
Yeah,
especially if they've been there and
yeah,
done that. There's always workarounds. Because
yeah,
I remember there's one deal I came across, and they were asking for 2 times revenue because it was growing, and I just threw it away. I thought they were unreasonable. Now I know
yeah,
I was just lacking skills.
yeah, man. So it's tons of strategies out there with about the level of experience that the person who's underwriting the deal, or performing due diligence, or whoever's leading that acquisition. It's up to them and how knowledgeable. But hey, these companies, man, like I said, just because you couldn't buy it, another guy's going to come behind you and make that acquisition, and he's going to see no problem with it. So always keep that in mind.
Facts. Solid. And you could drop a separate video on that, Ansi, and go a little more in depth. Perfect, guys. So we'll leave it here. I appreciate you guys watching, and we'll see you on the next episode.